Welcome to Zen and the Art of Real Estate Investing. What if you could learn from experienced real estate investors, find out what got them to where they are now, get insight into their daily habits, and take these insights to inspire your own growth? Each week, Jonathan Green shares an in-depth look at the mindful approach to real estate investing. Jonathan is a lifelong real estate investor, advisor, and coach, as well as the founder and team leader of Streamlined Properties. Whether you're looking to start from scratch, get to the next level, or just for a straightforward and honest approach to real estate investing, Jonathan seeks to provide a free mentorship program you can take with you anywhere. Now, here's Jonathan.
Welcome back to another episode of Zen and the Art of Real Estate Investing. Thanks for being a valued listener, and today I have a great show for you. It's Andrew Cushman of Vantage Point Acquisitions. He is the founder, and what do they do? They're a real estate private equity firm focused on acquiring, repositioning, and operating B- to A-class multifamily communities. But we're going to go all through how we get there, and it started with flipping. Let's go. This is episode 258 of Zen and the Art of Real Estate Investing with my guest, Andrew Cushman. Andrew is the founder and principal of Vantage Point Acquisitions. He left his career as a chemical engineer to get into real estate in 2007, started with house flipping, went over to multifamily in 2011, and since then has syndicated or repositioned close to or over 3,000 multifamily units. Andrew, welcome to the show.
Good to be here, Jonathan. Appreciate it.
Yeah, and we were just talking. You're in a power outage. We're recording in a power outage, so things could get a little wonky, but thanks for sticking it out, and it's good to have you.
Yeah, for anyone who watches the video, it kind of looks like I'm in the witness protection program here, but because I got no lights, but I got a laptop on battery and a phone hotspot, so hopefully it makes it through. So.
Yeah, modern technology. Let's do it. So why did you leave chemical engineering for real estate in 2007? Was it something you thought of before, or was it something that just happened?
It was something I thought of in high school, actually. As a kid, going all the way back to 5 years old, when I was 5, I would walk around the golf course with my grandfather that he lived nearby. And I'd fish the balls out of the rough and the bushes and then clean them up and then take my little red wagon and go sit at the crosswalk and sell the balls back to the guys who had lost them.
Yeah.
And so I got a picture of me at 5 years old holding $17 and I felt like I had all the money in the world, right?
That's rich.
And of course, this is the early 80s, so it actually was a meaningful amount of money. But, and so I was just doing things like that ever since that age. And in high school, I knew hey, I want to be an entrepreneur. I want to do my own thing, but I had no idea how to do that or what that meant. So I figured, hey, I'll just go get a chemical engineering degree in the meantime. That way I'll always have job opportunities and they'll always pay well until I figure out what I really want to do. Got the engineering job, got married, 7.5 years into the engineering job. My wife and I tried a bunch of businesses along the way, and then we discovered the flipping. Yeah. And it was brutal, but we finally got our first deal after 6 months. And then when we sold that, we made as much as I made all year long at my engineering job. And I said, all right, that's it. There's no better sign than that. I'm out. This was 2007, as the economy's collapsing. But I'm like, I don't care. That means there's going to be opportunity to get houses. And, it's been full-time in real estate ever since. And again, like you said, after a few years, transitioned to multifamily. So.
Yeah, I think it's an important note for newer listeners because having a fallback career is still important. Not everyone's going to be successful or know exactly what to do. And I had a career as an attorney, and everyone says oh, well, what are you going to do if, real estate fails? I'm like, I could just go be an attorney if I wanted.
And you're exactly right. And, that's how you overcome that fear of making the jump and is give yourself runway. We sold one first. I now had a year's worth of salary in the bank. Now, it was working capital for the business. Also, my wife kept working for 2 more years. And then I made dead certain that I left my engineering job on really good terms. So the last thing they said to me is hey, if you ever want to come back, just let us know. So what's the worst thing that can happen? Well, I do a 9-month experiment and go back to my old job and I'm no worse off than I was. So
Yeah, I just think it's important because I read, there's all these things out there about FIRE movement and people, 22, 23 saying, I can't wait to get out of my corporate career. It's like, you need money and you need a skill set, no matter what your corporate career is, even if it's not, white collar, maybe it's blue collar. Those skills are great for real estate as well. I just think you always want different fallbacks. That's why you were a 5-year-old entrepreneur, because you knew there was going to be other things that you could do.
Yeah.
Yeah, it's interesting. I mean, times have obviously changed, but when you made the switch from single family to multifamily, was it one of those aha moments like, hey, I can just do this bigger? Because flips I still find them enjoyable and hate them at the same time.
Yeah, you're exactly right. So 2007 and 8, we had no competition. It was awesome. I'm in Southern California. There was tons of equity. No one was buying houses then. 2009 and 10, we had really good years, but competition was picking up, and there was less and less equity to be bought into. And then also flipping, it was just my wife and I. I know there's some guys out there now who have turned flipping into like a massive business, and they have it systematized and all that. And we didn't have those skills. It was just the two of us. It was a far more brutal job than the jobs we had left. And so we said, all right, we don't really want to keep doing this. We had good years, but it's getting harder. We don't like it. And he said, well, how do you scale real estate? And then we kind of thought along, well, hey, we just had a huge recession, which means we're probably going to have a long expansion. And a long expansion means job creation and income growth. But everyone and their mother just got foreclosed on and can't buy a house for 5 to 7 years, or they know someone who got foreclosed on and they're scared to buy a house for 5 to 7 years. So, okay, no one can buy houses, but you have an expanding economy. Rentals. That's going to be the place to be. And so we had a mentor for flipping houses. We called him one day. I was like, hey, do you know anyone who does apartments? He's like, actually, I do. And he connected me with a guy who bought like 800, and I talked to him and hired him as a coach. He held our hand for the first year. Our first deal was 92 units out in Macon, Georgia that we syndicated.
Oh, wow. That's big though for a first one.
Well, it sounds bigger today. I paid $900,000 for that. No, $700,000 for that one.
Yeah.
Right. So like $7,500 a unit.
Yeah.
And then, we got along so well that we became partners on a few deals, and then, just kind of expanded since then. And like you said, are about 3,000 units today, and it's been a real good business. So.
Yeah, but how did you know to take on the coaching? Because some people kind of, we both know there's a lot of fake gurus out there. There's a lot of courses. How did you know that taking that coaching was going to be in your best interest at the time? Was it because it was a personal referral, which I think makes a big difference?
That was a big piece of it. And then, that's one of the reasons we chose real estate is because we're just not that creative. I'm not the guy who's going to create the newest app or some technology. Like, the great thing about real estate is you don't have to figure out any of it. It's all been done. All you have to do is find someone else who's doing what you want to do at a high level and figure out a way to copy them. That might be hire them. I mean, there's, but you don't actually have to figure any of it out. You just have to execute. And so that's how we knew, like, we just need to go find a coach for this stuff. We're not going to go jump into these huge buildings on our own. And you can kind of figure out flipping on your own. It's not, the stake.
Poorly with a bunch of red cards along the way, but you can get it done.
Yeah. I mean, the stakes are lower. It's usually one house at a time.
Yeah.
I mean, it's just, people, you can kind of do that. Multifamily is a whole nother ballgame because often you're also bringing in other people's money. So now you have a much higher level of, fiduciary responsibility. So number one, we just know, like, this is not something to just go in willy-nilly and figure it out. Number two, like you said, yes, it was a referral. And then 2 and 3, we verified the guy had actually, he wasn't a guru. He was a guy who had just gone and done 800 units. And when we talked to him, he's like, yeah, I was thinking about doing some coaching or teaching or something like, and so it's just kind of like, all right, this is the thing we need. It wasn't like he didn't have commercials. He wasn't advertising on Facebook. Yeah. He wasn't yelling on YouTube about taking massive action. It was just none of that kind of stuff. So.
No email follow-up plan the second that you hung up, making you into a funnel. Yeah, but those are good signs, though, for people to look out for. Because, look, it's fine to run a business. There's good coaching, there's bad coaching. And most of the time, I always find that it's kind of user error. Because, as you said, nobody's coming up with something new in real estate coaching. They're just telling you what was on the Carlton Sheets tapes and the stuff before that. Like, real estate hasn't changed that much.
I actually remember that guy. He was before I got into it, but his name was still floating around. But again, that's the beautiful thing about real estate is it's really just down to you and whether or not you execute. Like, That's the only variable. And that's why I love the business. It's not, oh, will this work? Or, can someone figure this out? Like, that part's answered. It's just, do you have the ability to execute? And we were committed to doing that. So.
And don't you think that your probability of execution goes up so much more when you surround yourself with, like you were saying, people who are doing the same thing? Because that's where I think it's a little bit harder for people. If they don't know any real estate investors, how are you going to be a real estate investor? You're going to read the book, but there's still, like, it's different. You can read a book and then go try to do it. The two things don't match up.
And it's also can get to be a bit of a lonely business, right? I mean, if you're off investing in 100-unit apartment complexes, how many people in your normal day-to-day circles can relate to that? and if you're like, oh yeah, I just bought 100 units, and they're either going to completely not relate, or they're going to be mad at you because they think you're bragging, or just be jealous or envious that you're. I mean, it just doesn't tend to go well, right? So that's another reason to get in those circles.
Yeah, and I mean, really, if they think that you're a braggart, you should just have them come out and manage the 100 units for a day and see how much they like it.
Yeah, they'll be like, never mind, you do this.
Yeah, right. Was that a worry for you, or did you know going in that you were either going to use management, or kind of because you had that help of a coach to say, like, hey, 92 units isn't going to be a problem. We're not trying to be 92-unit landlords right away.
Well, people ask me, like, you went straight to 92 units from zero? And like, well, yeah, because it's easier that way. If you buy a 5 or 10 or 20 unit building, it's really difficult to manage that stuff because the third-party options aren't very good. Right. And if you're not using third-party, that means you're using yourself. And I'm like, no, I want to be an investor in the business owner, not resolving the conflict because the lady in unit 3, her dog bit the guy in unit 4. Like, I don't want to be involved in that stuff.
I don't want those calls.
Yeah, so that's one of the reasons we went straight to 92 units, is because once you get over about 80 units, those are properties that are big enough to support full-time on-site staff. So we knew, like, hey, if we get something close to 100 units, we can hire a full-time property manager, and she's going to live there, and she's going to run the property. And we're going to have a full-time maintenance person who's going to live there, who's going to take care of all of that stuff. So that is actually why we went straight to the big stuff, so that we wouldn't be involved in day-to-day. Now, with that said, in the beginning, the guy that I hired as a coach, he actually was self-managing, so he had his own kind of property management company for his 1,000 or so units, and so we had him do it. And then about a year or two in, he was like, "Oh gosh, this is the biggest headache ever. Like, we're going to get out of this." And so then I went and did an extensive interview process, found a great third-party management company to partner with, and we still use them to this day on our entire portfolio. Awesome. Now, like over a decade later. Like, we're very deeply integrated. It's really hybrid management, not third-party, and it's been a great working relationship ever since. So.
Yeah, I mean, that 80 to right under 100 is great for, like you said, on-site management. But I also think it gives you an option as a new multifamily higher-end buyer. The hedge funds aren't buying 80 units, so you're kind of against other investors who are starting to syndicate. But people can pull that off on their own as well, depending on the prices. So the pool's a little different. Once you're in the 250 range, obviously you have different competition, right?
Yeah, the competition changes as you move up the scale. And, if someone's listening going, well, that's great, I'm not going to go straight to 100 units. Plus, the pricing now is 10 times what it was when I was doing that. So it's a little bit different. But, if I talk to people who, I'd say, actually, I've got a friend who lives in Columbus, and Columbus is a good market and wants to invest in Columbus. Well, can't go straight to 100 units. Okay, fine. If you can buy a 10 unit and a 15 unit and a 20 unit and another 10 unit and keep them all kind of in the same general area, pretty soon you can get close to that 100, package them together, and then hire those two people to run them as a small portfolio. And the best part is, when you're buying 10 and 15 unit or smaller properties, those trade at higher cap rates. And then when you package them together and say, here's 100 units I'm going to sell all together, that will, everything else being equal, that will trade at a lower cap rate. So you can force appreciation simply by collecting properties and then selling them as a package if they're all in the, about roughly the same class.
Yeah.
Same geography, and then you've proven that they can all be managed with the same team. So that's actually a great strategy. So you don't have to go straight to 100 units. We just did it because we were able to. It was the right time and place. And no, we didn't have the money. I went out and syndicated it, and it took 6 months, and we barely made it across the finish line. It almost killed us. But so there's different ways to get there, but that's the way that was open to us and that we chose.
Yeah, I ask this question a lot for people's first time raising money. How was it when you had to go out and get money? Who were you going to? Was it people who already trusted you in other professions? Or how were you trying to market it? Because now it's a different story. Everybody has flashy PDF. Everything looks great. But back then it was a little different. And you were still new to the space, really. Not new to real estate, but new to multifamily, which makes it a little harder.
It was very hard. And candidly, we're kind of getting back to how it was in 2010, 11. I mean, we had, if you think about that time period, we had just hit the bottom of the most significant real estate crash in, generations. And because of that, everyone was terrified of investing in real estate. In reality, that was the best time in probably the last 70, 80 years to invest in real estate, which is typically the case. Everyone does the opposite of what they should do. So it was really hard. So our first check was my mom. And then basically what we did is we went out to everyone. So how we funded the flipping business is private money. We'd say, hey, we're buying this condo for $300,000. We need to give the guy $100,000 in cash. We'd just go to somebody that we met over time doing the business and said, okay, we need $100,000. We'll give you 10% interest in 2 points, right? And so we had built up a small list of investors that way. Then when we went to multifamily, we of course went to them. Some of them did come over to multifamily, and then we expanded from there and just kept networking and networking and networking. And like I said, we had to raise $1.2 million. It took 6 months. We almost didn't get there. How we finally got across the finish line is we actually went to the seller and said, hey. And this is very true. We said, look, your property's in a lot rougher condition than we originally thought. Yeah. We're not going to retrade you on price, but we want you to carry a note for a few $100,000. And he agreed to do that. And that's how we actually get the last big chunk of the equity. And then we repositioned the property, refinanced a couple of years later, paid everything off, and we were good to go. But that's how we did it. These days, it's kind of similar in that even from just 6 months ago, it is, people are far more hesitant to invest than they were even 6 months ago. Now, part of it has to do with tariffs, tax on, tax off, and all this other stuff that's going on in the world, and people are just uncertain, and the sphincters tighten up when that happens. Yeah. But also, it's just kind of real estate's gotten kicked a little bit, and so people are scared. It's like, actually, no, now's the time to do it. Not when it's going up and everyone's jumping on the bandwagon. Like, you want to already own it at that point, so you just sit back
and then rise.
And then start. And when the rise, after the rise goes for a little while, now then you start selling into the frenzy and do that kind of thing. So
yeah. But when you got to multifamily, obviously it's a different game than flipping. Flipping, you finish, everyone's paid out, you start again. Multifamily, there's a longer payout for people. How did you get that across to them? And, for people who are looking to be LPs now and do real estate syndications, this is something we always ask. That's going to be illiquid money for a while, and they have to understand that. But when you're new, you're like, I really need it. You're also not going to get it back right away. And you have to really figure out how to describe the terms, and that the asset and the debt that you're using are all kind of complementary to their investment.
Yeah, so the guy who funded more of our flips than any other person, when we went to him and said, hey, we're doing this multifamily thing, he looked and said, it was a 5-year pro forma. He looked and said, this looks like a great deal. He goes, but I might be dead by then. Right. And I'm like, dude, you got to be a little more optimistic for one. But people that you have to match up investor expectations with your business model. If you're an investor who wants to get their money back in 1 or 2 years, or is just looking for 10% interest every month for 18 months and then get everything back, that's not a good fit for multifamily syndication. You need to match it with investors who can kind of see through the noise and are looking for the signal, which is, long-term things, long-term trends like supply shortages and rent growth and population growth and all that, and who understand, multifamily generally is a blend of cash flow, tax benefits, and appreciation. And it's as if they can, and then typically the longer you hold, the better it gets. And so it's you got to match up expectations. That's really the key. That means you don't just accept anyone who says, "Oh, I'll invest." You need to actually have a bit of a vetting process.
Yeah, I mean, I feel it's just like so hard the first time you do it not to take someone, but you have to learn that lesson, because the people those are going to be the most annoying limited partners. Like the whole point is for them to stay silent, and then you take the wrong money and you're on a call every week about one number on the PDF, and you're just like, oh, I didn't need that 50 grand. I just should have left it alone.
Yeah, and on our first deal, we took anybody and everybody we could. That was the reality of it. Nowadays that's not the case. We have an onboarding process that includes a short survey. Then we have to do a one-on-one phone call, and then assuming all that goes well, then it can potentially get added to the list. So it's a little different now.
Yeah. In the last year, have you seen the profile of who's investing changing? Because I've been thinking that I believe that the LP investor is going to get younger, but I'm not sure how it looks on your end. I know that I didn't get interested until last year, but now I wish I got invested earlier in syndications, but also I don't think I was ready. I was still too into the control aspect, and now I can't wait to give up control. But do you think that the profile for LPs is going to get younger?
It could. We haven't seen that as a noticeable trend. What we have seen in the last two deals that we've done and raised for, the most recent one having closed early April of this year, is that the people who are investing are the long-term recurring investors. The ones who've been through the cycles before, the ones who understand it's a long-term game and that disruption typically equals opportunity. Those are the people who filled up the last two. And we're telling this is a 5 to 7 year deal. And we really believe that by the time we get to 20, 28, 29, and 30, we're going to, rents are going to be way higher, valuations are going to be way higher. We've got, that's one of the cool things about real estate, and especially multifamily, is unlike the stock market where you're living and dying by the quarterly report, you can look 2, 3, 4 years out at the where supply and demand is going, and position yourself ahead of that to reap the benefit. I don't know too many other investments that give you that kind of forward-looking visibility. So our investor profile has shifted to those who've been or maybe even older. So they've been around, they've seen the cycles, they understand now's the time to do it. And yes, the price of this thing could go down 5% in the next 6 months. But 5 years from now, when it's up 30 or whatever, that doesn't matter. Because also, unlike the stock market where you can be in cash and hold, I'm in, and you can literally build a stock portfolio in a day. You can't do that with a real estate portfolio. It's accumulated over time. The deals pop up, and then if you can't, they're gone. Someone else is going to buy it, and it's off the shelf for 5 years. So it's a very different animal. And so the people who understand that more seem to be the ones that are investing now.
Yeah.
And as opposed to 2022, where it was just kind of the hot, sexy thing to do, and everyone was just piling in.
Yeah, but then asking 6 months later, hey, can I pull that money back out? I want to repurpose it into something that has a 0.01% higher yield. That's not how it works. But so I found for myself, I don't know about what you've seen, but the illiquidity of it to me is actually the attractive part. Mm-hmm. And that's not how I used to think when I was younger. Because when you're flipping, like you started with and I started with, it's like, oh wow, 6 months later, I just cash out and I do it again. And it's kind of fun, even though it's annoying when it's going on. But now I'm almost protecting it against myself, knowing hey, I don't need this money. That's why it can be illiquid. So I always tell people, if you think you're even going to need it, then this isn't the right avenue for you, because there's nothing we can do at that point. And that's part of your conversations when you're doing those one-on-ones, right?
It is. That's, in fact, we have a set list of questions then that we always try to go through. And one of them is, are you comfortable with 5 to potentially 10-year hold times? because that is the intention. It's a long-term investment. And then also, I've had this conversation with, if someone's thinking about, hey, I want to go be a sponsor or a syndicator or do this as a business, you're not going to make much for the first 5 years because, as a sponsor, you get acquisition fees and asset management fees and all that, but those just cover the bills. You don't get wealthy off of those fees. Where you get wealthy from is successful deals that you eventually exit. So even as a sponsor, in fact, a friend of mine who's very successful now, he was about 5 years in. I remember we were at an event and we were sitting on a couch and he's like, man, he goes, when does this start to pay off? And I was like, just hang in there. Like you got to get about 5 years in. And then, as long as you do good deals, then it starts to pay off. But in that first 5 years, you're just paying the bills and overhead with those acquisition fees and stuff. So.
Yeah, I mean, that's a good corollary to real estate as a whole. I mean, long-term thinking is always going to be better than short-term thinking. It's like that little diagram of the person pushing a ball up the top of the mountain to get momentum. And it's like 4 years and, 364 days. And like, you know what? I'm just tired. I'm not going to push. And if they just pushed it to the 5 year, it rolls over and it rolls the next 5 years on its own. That's what all of us want, that snowball effect. But it is hard because even me knowing syndications and knowing what I'm putting in, when somebody tells you, hey, this could be 5 or 10 years, you get that little nervous, like, well, 5 is fine. But now you're saying 10, like, I don't really want it to be 10. I don't know why, but because it's going to get better. But it's just that, corollary of what you're thinking about time and can you have your money and what's happening to it.
Well, and you're right. You don't want to go to an investor and be like, this is 5 to 10 years. Right? I mean, you need to have a little more narrow window. So like, for example, what we do, I'd say 80% of we do single asset raises, which means like, okay, here's the deal. It's not a fund where, we're just kind of blending stuff
1,
together.
2, 3 Main Street. Yeah.
And so it will have a defined, like this is a 5 year, this is a 6 year, based on the asset, the market it's in, all of that. Probably 20% of our stuff this is 8 to 10. Right. Because we have some investors who really want that. And so when we see a property where we feel like that's the best hold period, then it matches up well for them. But the vast majority of our investors want that 5 year range, and the vast majority of deals fit well in that, partially because when you do a renovation, if you hold more than 5 to 7 years, that stuff starts to fall apart. And now you need to recapitalize and renovate again. And so unless you have to, raise the capital for that up front, that might get tough to do. And so that's that's another reason that 5 years hold time works well.
Hey, it's Jonathan. I hope you're enjoying this episode with Andrew Cushman. And if you're really enjoying what he has to say and you're interested in getting in touch with him at Vantage Point Acquisitions, you can take a pause from the episode and go to VPACQ.com. That stands for Vantage Point Acquisitions. And right at the top, there's Join Our Investor List. You can also invest with them. Look through their About Us, VPACQ.com. Let's get back to Andrew. Yeah, during the time when syndications, everyone, was investing in them 2020, maybe to 2022, did you find a lot of operators were thinking everything was going to be more 3 to 5 years, but then, now we hit a cycle where that's not really possible. Do you think that's part of the reason why some operators and some of these syndications got messed up during the time? I mean, that's what people are reading about and maybe what scares people from syndications.
I mean, that's one of several reasons is people developed way too short-term thinking for commercial real estate. And then, on top of that, there was a good period of 5, 6, 7 years where operating these things was easy. Like you just had to, again, follow a YouTuber and take massive action, go buy it, and rents went up and it stayed full and everyone looked like geniuses. The problem is most, every single multifamily guru camp and all that I've ever seen, like including the legitimate ones, all they focus on is how to get the deal, and then how to raise the money for it. I don't know of a single one that tells you what to do on day 2 after you close, right? Like, what do you actually do with this 100-unit property that you just bought that has got 100 families living in it, and now you're a big part of their lives, and you have 100 investors in it who are counting on you to not lose their money. No one teaches what to do then. And part of what's happened is again, for a long period of time, you did not have to be a good operator. Things just went up.
Yeah. Now
you actually have to be a really good operator in order to have your property, just to do decent. And what's happening is all the folks who quit their IT job 3 years ago or 4 years ago because they went to a camp and the market was booming and, hey, this is easy. It's not.
Yeah.
And that's another reason. So you had people who overpaid, who used the wrong type of debt and don't have the operating experience. And now you don't have to have it, but you should have someone on your team who does, right? And so you put those three things together and you end up with a lot of deals going bad.
Yeah. Yeah. I mean, I think that's what's, I guess, people who are looking for passivity, but it's crazy to me. We both know that flipping houses, of course, isn't passive, but even investing in a 10 unit on your own, not passive at all.
Oh, no.
It's like the least passive thing you could ever do. The more units you get, that's not fully managed. And even fully managed by yourself, that means you still have to manage the manager or you're going to lose. So I think people just have to come around to really like, what is passive income? And what are they really looking for? And most people, again, as I was saying, and probably you've experienced, it's a control thing within yourself. So the self-awareness of the investor is really important, because you have to know, like, I'm ready for this. I'm ready to want something that really is passive, meaning I can't turn any knobs. It's just out of my hands altogether.
I mean, the only true passive income is, you maybe, buy Johnson & Johnson stock and they give you a dividend every quarter, or treasury bills where you just get an interest payment every month. I'm in a mastermind called Go Abundance, and we call it horizontal income, meaning it shows up on a regular basis. It's consistent. It's reliable. You don't have to necessarily grind every day to get it, but there's still some form of management that needs to be done, or attention paid to it, or some kind of involvement. And so, especially as a sponsor, it's not passive at all. It's a full-time job. I mean, we've got a whole team of people that we employ, and that doesn't even count the people on site. I think every year, I think we have to send out 600 K1s or something. I mean, just tax season is a giant ordeal in of itself. So there is nothing passive about it, unless again you're an LP. But even as an LP, it's passive once you make the investment, but it needs to be active up front when you're vetting the sponsor and vetting the deal. You need to spend some time digging into that, and then also actually read the quarterly or monthly reports, and and follow up with whatever's going on. So
that's a great point. It is very, very active in the front end. I mean, everyone can get that from Brian Burke's book. Like, just focus, but you really do, because even when you don't know what you're reading on the pro formas, you have to go through them, compare them, and figure out what's in there. And again, you have to understand the debt, understand the operator, track history, everything that's out there,
and be aware of what's not in there.
Yeah, great.
That's often the thing that'll get you, is what's not in there.
Yeah. I mean, again, it is getting harder, because you can just go into, some AI ChatGPT and say like, hey, just make me a 40-page, thing that looks great. So anybody can. So a lot of it comes from relationships over time. And as you were saying, a lot of your investors are just repeat. And I found that that's really important in the syndication game, is you just want to have the repeat. So then you have a wait list, and you can bring in the people when the actual asset, since you're doing one-off, is right for them. Like, hey, they were looking for multifamily in the Midwest. Okay, here, we have something for you. Instead of having to go back to your first raise days and, scratch it out. Hey, anyone just throw it in here. We'll take whatever you got.
So that was brutal.
Geographically, what are you looking for now? Because I think for a lot of people, some people are like, hey, we know a lot of people, we'll look at deals anyway. Do you have any geographic restrictions in terms of where you want to do multifamily syndications?
Yeah, that's a mistake that I see a lot of people make, is just chasing any deal anywhere. So we have very clearly defined, we will buy in North Florida, Georgia, the Carolinas, Eastern Tennessee, and about 3 counties in Alabama. And that's it. So we won't buy in Texas or Utah or Idaho. Those are great markets, but there is efficiency and both economic and operating benefits to being in one kind of consolidated geographical area.
Yeah.
Also, what you'll find is the longer you're in a market, the better you get to know the market. So you're less likely to get surprises like, oops, I bought on the wrong side of the tracks, right? Like if you've been investing in that market for 15 years, the odds are you're not going to make that mistake. Second of all, you build the relationships that make the business work. Flipping, again, it's very transactional. Kind of all you got to do is find the deal and you're done. Multifamily, it's all relationship based. Whether you're going straight to owners or working with brokers, it's very, very relationship based. And so when you've been in you pick a market and you become an expert in that market, and everybody knows that you're the expert in that market. That's how you get the best deals. The property that we just closed on never got marketed. It was never listed. No one else saw it because we had purchased another property from the same owner 7 years ago. Yeah. And then the broker was talking to him and he's like, yeah, I think it might. And so the broker's like, oh, perfect. We know just the guy. We know just the group for this property. And again, we had bought from the guy before. He's like, oh, yeah, they were great the last time we trained. And we just did a deal. Like nobody else saw it. Yeah. Partly because we've been in that market for 15 years almost. And everybody, the brokers, the deal makers know that. And so part of success in this game, again, if you're buying deals, is you want people to think of you first when they see a deal that's perfect for you. Right? We don't see every deal. There's lots of deals that someone else buys that we never saw either, but that's okay. Because number one, we can't buy everything in Georgia. And then two, we only want the ones that are a perfect fit for us. And so that's, so there's a lot. So the long answer to the question is Southeast US, because all of that, and it's business friendly, landlord friendly, population growth, job growth, income growth, all the things that give you, positive tailwinds for multifamily.
Yeah, those are great points. And I've found that it's a trust factor, then the relationships, but generally it's just a Glengarry, Glen Ross thing. Coffee is for closers. And when you're going for large scale commercials, they don't really want to test out, the new person coming in from Brooklyn. And I'm from Brooklyn, so no offense to Brooklynites, but they want a proven operator who's just going to close. That's why a lot of deals don't go out to market. It's not like somebody needs to advertise a 211 unit on Zillow. Like no one's looking for that. They're looking for their dream home down the street. So it's a much different game. And I think it's really important to know that in advance for the listeners, because you went from single families, one at a time to 92 units. You have to know once you get into that game, it's a whole different, you can't mess up. You kind of have to really build that reputation from the start so that you have a foundation for that long term. Like you said, hey, we've been in this market for 15 years. And then you can say, hey, we've done projects here, 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 if they didn't know you. And then they can just look it up and realize, oh, that's solid. Because you just want someone who's going to close. The last thing you want is to spend 6 months on due diligence and working things out just to find out that the buyer was fake.
Yeah, everybody just wants someone who's going to close. I mean, the sellers, the brokers, everybody. Yeah,
so. And easy, no pain. Because when you deal with professionals, if you guys come in, they know what you're going to do. They know that you're going to kick the tires. They know how you're going to kick the tires. They know you're going to be reasonable. Especially going back to what you said when you didn't try to retrade on that one deal, you just said, hey, why don't you just toss a little seller finance? And they really know, like, hey, we can trust them if that's their price, and barring something crazy, they're going to stick to it. That's really, really important with these units and for those sellers. And like you said, for the brokers, everybody involved, it's too much of an asset to risk on an unknown quantity.
Yeah.
Yeah. So, geographically, because you're there, do the weather anomalies affect how you invest now? Just because we see it getting worse sometimes, although I grew up in New York, and we had 7 hurricanes a summer growing up. So I've been through a lot of weather issues.
Same here. I spent a good part of my, pre-professional years in Texas and New England. And candidly, I think part of it is we just have far greater reporting of severe weather events nowadays. Everybody, I mean, back, when I was a kid, the dude from the Weather Channel had to drive down and try to intercept the storm and tie himself to a lamp pole to get view. Right now, every single citizen has an HD video camera in their pocket, and any single little event that happens is going to get, over documented. So, not to say weather hasn't gotten isn't maybe trending more extreme. We have had quite a few, above average hurricane seasons.
Yeah.
But at the same time, it's clearly far, far more reported than it ever was. So, I mean, I think to me, the concerns that come from climate change concerns are so long-term and slow-moving that they really aren't going to be on our radar or the typical real estate investors radar. Now, if you're going to, one of my goals is to buy an apartment complex personally and hold it for 20 or 30 years. Okay, I might factor some stuff in. But when you're talking 5 years, climate change is not a 5-year scale thing. So, we have, 550 units on the Florida Gulf Coast. We just we've got it insured. And in 2018, we had one get completely destroyed by Hurricane Michael. And we rebuilt it. And while I would never wish to do that again, financially, it ended up being one of the best things that's ever happened to us, because we had a property that was built in 1987. Now we have a property that was built in 2019, and it rents way better and it cash flows better and it's worth more. So there's upsides and downsides. Also, and this is something we don't buy in flood zones. We've never bought in flood zones. So we do, we are cognizant of that. And if you're right next to one, those maps aren't exactly perfect. So you got to be a little careful. So, but again, that's also why we like North Georgia, South Carolina, Eastern Tennessee, is those are places that tend to not have major catastrophic weather events, right? No place is completely immune, but you don't get hurricanes in Eastern Tennessee. You might get, I guess, a tornado, but there's just, if you spread out a little bit, you can kind of mitigate that. So it's something that we're aware of. And, I will not buy a property that's on the beach in Florida. But, will
that's
I
just
buy
too much risk. Yeah.
To me, I'm just kind of asking for it, right? It's like, I don't know.
Yeah. You're in California, though. It's like, the houses that are hanging over the side like that just scares me. I just don't want to have a mudslide and my house go down. I'll just stay a little bit further back for less of a view.
Yeah. And, and like you said, I'm in Southern California, but I also don't live in an area that's prone to wildfires. So like I wouldn't want that stress either. So there's ways to mitigate it.
Yeah, I mean, there's insurance for a reason. And of course, the premiums go up. But after they go up a lot, they always come back down. And I learned a lot. I lived in Florida for 14 years. And I remember with the weather there, it was always like we would get an alert. I was living in Sarasota at the time. We get an alert 4 days and it's like, oh, huge hurricane's coming. I lived like right on the water, like a block from the water. So then drive to Fort Lauderdale. But then, a day before, it's like, nope, storm just switched. Now it's going to hit Fort Lauderdale. So it's like, oh, drive back home and it doesn't even rain. So it's like these things are still, chance. Of course, as you said, we're going to get a lot more updates on them. But still, tornadoes are chance. How can you predict when you're going to be in the path of a tornado? You just want to know to stay safe and have insurance. Do you see anything changing in multifamily in 2025? We're recording at the end of April. It's going to come out in July. Do you see more opportunity for people who want to get into large-scale multifamily, either on their own or through syndications?
Yes, I see more opportunity coming later this year and probably even more so in 2026. That's one thing we've been wrong about, is we thought there would be a lot more opportunity starting in late 2024. And candidly, we underestimated the willingness of banks and lenders to play along and extend. Now, you got to ask yourself, why are they doing that? Is it because the bankers suddenly got friendly and feel bad for these operators and don't
go
worry
on
about
that.
it. Yeah, maybe one or two. I do know a couple great bankers I work with that I think that do have a heart. But the reality is, at the end of the day, the banks are looking out for the banks and their balance sheets and their investors. And so what that means is they're just looking at it at right today and say, well, hey, if we get aggressive and we start foreclosing, number one, we learned in 2008 that if we get too aggressive with that, it exacerbates the problem and we feel the pain. So, okay, let's not do that. Yeah, but they know, like, hey, if we got a property that's underwater by $10 million and we foreclose, and that means we're going to take a hit to our balance sheet. Whereas if we extend this for a year, we can not take that hit. Well, as soon my thought process is what we believe is as soon as the lenders believe that they can make themselves whole by getting aggressive and saying, nope, no more extension, no more modification, this loan's going to be paid off, either you sell it or we're going to sell it, and they can make themselves whole by doing that, that's when you're going to see a lot of this stuff get forced through. So ironically, when we could see the most opportunity is, again, for right now, I feel like we're bumping along bottom. We've hit bottom. It's not a flat line. We're just kind of bumping along. Once things start to move up and the market strengthens, I actually think that's when you're going to see lenders get more aggressive about forcing properties. And you're going to get a lot of really good opportunities because as soon as they get a chance to think about it. It's the same psychology as someone who buys a stock and then it immediately goes down. Right. Yeah. And on paper, they've lost 20% for 3 years. And then something happens and all of a sudden that stock gets back up to where they bought it. What do? The minute it hits the price they bought it, they sell it. Right. Yeah. And so the lenders kind of behave the same way. It's like, oh, hey, we've been underwater for 3 years. We can now be
just
made
break
whole.
Even?
Let's just get out of this and be done. Right. So yeah, and not everybody's going to operate the same, and but that's just kind of a trend that I expect to see. And then also, you've got operator fatigue. You were talking about before. Yeah. You've got sponsors and investors that planned on being in these things for 2 to 3 years. They're now on year 5 or 6, and by the way, it's going to be 2 more.
Right.
You're going to have a lot of operators who just get me out as soon as I can. So.
Yeah, those are both fantastic points. I haven't thought of that, but I can even liken and see that to the single family, regular home market, because there's no REOs, there's no foreclosures still. But it's really interesting because I don't think just from the outside anyone would think, hey, the market's going to get better, and then here we're finally going to get some REOs. But it's like, no, that started to make sense because you're right. They just don't want to take a giant loss, and if they can break even, it's a win based on where they've been. And the houses, the important thing for the single family, and could apply to large scale multi, they had so much appreciation from 2020 to now that for someone who's fully underwater, the bank's still going to somehow make out okay. It's, at least where I live in the Northeast, everything's crazy. I don't know, the values are so high, no one can really be underwater unless they're just, gambling or something.
Yeah, it's pretty much the same thing here. You very much have a lock-in effect due to equity and low mortgage rates from previous years.
Yeah. Hopefully things will pick up. But in your day-to-day, over the time, you're still doing the same thing no matter what the, market or the news is saying, right? That's just being a really good sponsor and investor and multifamily syndicator. You can't really stop looking because you never know when a good deal is going to come from somebody, a relationship, or just through somebody, a friend of a friend.
You're right. Yeah. The fundamentals of good business and good real estate operation don't change. You might adapt some tactics based on the shifting market, but the fundamentals definitely don't change. And, it used to be we'd look at 100 deals to buy one. So the 2 deals that we've recently closed in the last 6 months, those are the first ones that we bought after an 18-month period of finding nothing. We looked at 1,000 properties to buy 2.
Yeah.
That's how difficult it is to get stuff that actually works right now. I suspect that number is going to start coming down significantly in the next 6 to 12 to 18 months. So that's an adaptation. You don't change the fundamentals. It's just, now you got to look at way more than you used to in order to get it. I think that's going to get easier as we get head forward. I'll be happy if it's 200 to 1, but fundamentals don't change. Yeah.
But that takes strong fundamentals, though, to pass on 998 deals just to get the 2, right? It's hard because at some point you're like, come on, this is so close, Yeah,
it definitely gets what's the word I'm looking for? You're just kind of you don't want to. It's like, okay, you get a great deal and like you just know, like, oh, this isn't going to work, right? Because like odds are 999 to 1 that you're going to spend time on this and then throw it away. But in a sense, it's not hard to be that disciplined, because so my original mentor had a great saying, and it went something along the lines of this: said the right multifamily property will change your life. The wrong one will make you wish you didn't have one. And after and especially in the early years, we bought some tough properties, and at the end of the day, they worked out fine. But I can tell you, a bad or difficult multifamily deal will suck up so much of your time and energy and effort. It's just not worth doing a bad deal. As an individual investor, as a sponsor, it's just not worth doing it. And so if you develop that aversion to looking past, well, hey, I might get a fee or whatever, realizing, I might get a fee, but I'm going to pay for it 10 times over with headaches for the next 5 years. It's not worth doing a bad deal. You're better off. No, that's actually one of our core philosophies. No deal is better than a bad deal. So.
Yeah, it makes sense. I mean, again, not only will it ruin your life, then it becomes a very hard to sell asset, even at a discount. So you've done everything wrong once it goes awry. And like you said, though, earlier, that can really come from, now you're seeing where people can buy good deals and then mismanage the operations and ruin it. Whereas 2020, you like you were saying, you couldn't really miss. Everything was going up. So even if you mismanaged, you were just making less than you should have, but you were still making. Now you can conceivably buy well and still screw it up because operations have to be really tight now.
Oh yeah, but that's opportunity for the next decade, because now we're starting to see the properties where the property's a good property, it's in a great market, it's in a good location, but it's 25% vacant. It's like, well, what's going on? Oh, it's because the sponsor has 8 other deals that are in trouble and they're spread thin, and it's a sinking ship, and so even great assets are going down with it, and so that provides opportunity.
Yeah, right. Good asset, bad management. That's a good deal. Conceiving everything else looks good, but that's a perfect one. Awesome, man. Well, I'm glad to finally get you on the show. I'm glad that your hotspot held out for our whole hour.
I'm going to have to check my phone battery, but so far so good.
Yeah, well, if it was in the old days, you would have like a $900 phone bill from this. So let's just be glad we've got that part going. But yeah, I really appreciate you spending the time, and I look forward to staying in touch with you.
Yeah, it's good talking with you. Appreciate it.
Yep. All right. That was Andrew Cushman. He's the founder and principal of Vantage Point Acquisitions. You can find them at vpacq.com, right, Andrew?
That's correct. Or also, I'm on LinkedIn. That's the only social media that I'm on. But if you reply in the comments, that is me posting and replying. So
me too. We're actually real people.
Yeah, we're actually real.
Yeah. You can always tell, though. You know the real people. Well, at least I do. Awesome, man. Thanks so much. Have a great day.
All right. Take care.
Thanks for sticking around to the end so you can get a preview of who's coming up on episode 259 of Zen and the Art of Real Estate Investing. And it's Brad Johnson, the co-founder and chief investment officer of Vintage Capital. He has 20 years experience investing in both traditional and alternative, that's going to be a keyword, asset classes. He's also the managing partner of Evergreen Capital, which focuses on public markets and advises Vintage on its investments. We'll see you next episode with Brad.